Look closely at the streets of our most vibrant cities, and you will see a quiet crisis unfolding in plain sight. It is not a sudden crash with blaring headlines and panicked traders. It is a slow, grinding pressure that builds year after year. It shows up in the for rent signs with impossibly high numbers. It is visible in the moving trucks heading for distant, more affordable suburbs. It is heard in the conversations of young families who wonder if they will ever own a home in the city where they work and contribute. This is the face of a long-term housing shortage, a structural deficit that erodes opportunity from the ground up. This problem is not confined to one neighborhood or a single metropolis. It is a defining challenge for urban centers across the globe. For decades, we have systematically underbuilt housing in the places where economic dynamism is greatest. The demand to live and work in these hubs of innovation has surged, driven by the magnetic pull of good jobs and new ideas. Yet, the supply of homes has been artificially constrained, held back by a complex web of policy choices, economic realities, public resistance. This gap between aspiration and availability is more than just an inconvenience. It is a direct threat to our long-term economic prosperity and social cohesion. A housing shortage is fundamentally a simple mismatch. More people want to live in a place than there are homes available for them. When this imbalance persists for a decade or more, it becomes a chronic condition. It warps the very fabric of a city. The market, starved of new units, responds in the only way it can, with escalating prices. Rent and home values detach from the reality of local wages. This forces a slow, painful sorting process. The city begins to lose its diversity, its energy, and ultimately, its competitive edge. The consequences of this slow-motion disaster are profound. It is an economic drag that operates silently, sapping productivity and stifling growth. It exacerbates inequality, creating a landscape of haves and have-nots defined by property ownership. It frays the social contract, making it harder for essential workers, teachers, nurses, first responders, who are the bedrock of urban life, to live in the communities they serve. Understanding this crisis is the first step toward solving it. We must recognize that a city that cannot house its people is a city that is slowly but surely setting itself up for economic decline. The housing shortage is not an accident of nature. It is the result of deliberate choices and systemic barriers. One of the most significant causes is restrictive land use regulation. Many cities are entangled in a web of zoning rules that make dense housing incredibly difficult. Minimum lot sizes limit building heights, lengthy and uncertain approval processes. A builder might spend years and millions just to get permission to break ground. These rules, sometimes meant to preserve neighborhood character, end up acting like a supply tourniquet. A second major factor is the high cost of construction itself. The price of land in desirable urban areas has skyrocketed. On top of that, costs of labor and materials have been steadily rising. A shortage of skilled construction workers further inflates labor costs. Combined with regulatory fees and delays, the price tag for new units becomes astronomical. The story of the housing shortage can be told through stark, simple numbers. Let us consider a typical major metropolitan area over the past 15 years. Data from economic research bodies consistently shows a dramatic divergence between wage growth and housing cost inflation. Median home prices have surged by over 150% since 2010. Median household incomes might have increased by only 30% or 40%. This creates a gap that is impossible for many working families to bridge. The dream of homeownership becomes a mathematical impossibility for an entire generation. The rental market tells an equally grim story. A widely accepted metric is that a household should not spend more than 30% of its gross income on rent. Yet, in city after city, this standard has become a distant memory for a huge portion of the population. It is not uncommon to find that over half of all renters in a major city are rent-burdened. For low-income households, many families are forced to spend 50% or even 60% of their earnings just to keep a roof over their heads. That leaves precious little for food, healthcare, transportation, and education. We can measure the shortage by looking at construction versus population growth. For a healthy market, a region should build enough new units for growth and to replace aging stock. Analysis of building permit data reveals a persistent deficit. A metro that added 500,000 new residents over a decade might have only issued permits for 150,000 new housing units. This cumulative deficit, year after year, is the engine of the affordability crisis. It's a simple equation of supply and demand. When hundreds of thousands of new people compete for a limited number of new homes, prices go up. This data paints a clear picture of a system out of balance. The problem is not that people earn too little in absolute terms. It's that shelter costs rise far faster than their ability to pay. This is not a market failure in the traditional sense. It's a market functioning perfectly under artificial constraints. The price signals are screaming for more supply, but policy frameworks and political will have failed to respond. The widening chasm shown in the data is a direct measure of our failure to build, and it predicts a future of deepening economic and social strain. When housing becomes prohibitively expensive, it acts as a brake on economic growth, and the most direct impact is on the labor market. Companies in high-cost cities struggle to recruit and retain talent. A firm might offer a competitive salary, but if that salary is devoured by rent, potential employees will look elsewhere. This forces businesses to either offer massively inflated wages, which cuts into their profitability and investment in innovation, or relocate to more affordable regions. When firms move, they take jobs, tax revenue, and economic dynamism with them. The city that was once a magnet for talent becomes a fortress that repels it, slowly strangling its own economic engine. The shortage also fuels poverty and deepens economic inequality. For families at the lower end of the income spectrum, exorbitant housing costs create a cycle of financial instability. When a majority of a paycheck goes to rent, there is no room for savings, no buffer for emergencies, no capacity for investment in the future, like education or starting a small business. This traps people in poverty and widens the gap between renters and property owners. As home values soar, homeowners see their wealth grow, while renters fall further and further behind, unable to get a foothold on the ladder of economic mobility. This creates a two-tiered society, undermining the principle of shared prosperity. The housing crisis is a problem of our own making, which means we have the power to unmake it. This is not a time for despair, but for decisive and pragmatic action. We can avoid the slow economic disaster. The solutions are clear, though they require political courage. First and foremost, cities must reform the restrictive zoning codes that block new construction. We need to legalize the construction of more diverse housing types: duplexes, townhouses, and single-family neighborhoods, mid-rise apartment buildings near public transit hubs. Streamlining and accelerating the permitting process is essential to reduce costs and uncertainty for builders. Second, we must directly address the high cost of building. Governments can help by reducing or deferring exorbitant impact fees for affordable projects and investing in workforce development programs to train a new generation of skilled construction workers. We should also embrace innovation in building technology, such as modular and prefabricated construction, which can significantly reduce both the cost and the time it takes to build new homes. Public-private partnerships can be used to assemble land and finance projects that would otherwise be economically unfeasible, especially those aimed at middle-income families, lower-income families. Third, we must create policies that prioritize housing for residents over assets for distant investors. A modest tax on vacant residential properties can create a powerful incentive for owners to rent out their empty units, immediately increasing the available supply. At the same time, we must robustly fund proven affordable housing programs. Using public funds and public land to develop and preserve housing for essential workers' low-income families is not just a social good. It is a critical piece of economic infrastructure just as important as roads, bridges. We need to treat housing as the foundation of a healthy economy. This is our call to action. We must choose to build. This choice requires us to look past our immediate backyards and see the larger economic and social consequences of inaction.